Well, hello and welcome everybody to the Europe Plenary session of the Gulf Intelligence Global UAE Energy Forum. I'm Diara Sapar, I'm a partner with Gulf Intelligence, and it's a pleasure to be your Master of Ceremonies today in this session and moderating some of the discussions. We're delighted to have everyone join us for this European segment of our annual forum, now in its 11th year, and under the patronage of His Excellency Suhail Mazrouei, the UAE Minister of Energy and Infrastructure. Of course, this year we're bringing this forum to you virtually, and that's allowed us to go totally global, crossing 4 geographies, and has enabled us to bring foremost thought leaders from the energy sector to join us for these discussions, to offer their insights on the year that's passed, 2020, and quite a formidable year that was, and particularly for the energy sector, and more importantly, to get their outlook on what lies ahead for 2021 and how the energy sector plans to tackle the continuous challenges that lie ahead. We, of course, saw some recovery in the oil markets and oil prices at the end of the last quarter, and we have seen that recovery improve and continue into at least the first couple of weeks of January. But we've also had very serious headlines, particularly in Europe, of renewed lockdowns and rising COVID infection rates. So where does that leave the energy sector, and how is it going to be managing its strategies? How are companies and countries going to be planning for the year ahead? And we look forward to hearing from all of our speakers today on what the outlook and expectation for that might be. We had 2 previous plenary sessions of this forum earlier today, one for Asia and one for the Middle East. And in both those sessions, we asked our audience what their forecasts were for the average Brent price for the year ahead. In the case of Asia, it was around $60, and in case of Middle East, it was $50. So that's the range of forecasting that we're seeing those segments of the industry expect for the year ahead. So let's see where that leads us. We're now in Europe. We're going to be focusing on that for the next hour or two. And I'm delighted to open this session to welcome and invite Dr. Rainer Selle, the CEO of OMV, to join us for the first interview of the session. So I'd like to welcome you, Dr. Rainer, and if you could please switch on your camera and your microphone. We're going to be talking to you a bit about how integrated oil and gas companies are managing and tackling the energy transition, both this year and the year ahead and going forward.
Okay.
We're getting a bit of background noise there. Hello, Dr. Rainer.
Hello, how are you doing?
How are you?
Doing good. It's pretty cold in Europe, and we are enjoying a very good natural gas business. So prices in gas have improved much better than in oil. But well, I grew up as a gas pipeliner, so that's why I enjoy, especially now, the gas. It's one of the few moments you can enjoy 2020 and 21 that a winter has arrived in Europe and helping us a lot, because all these oversupply we have seen in the market is now disappearing. So St. Peter is helping us.
Okay, well, that's good news. Good news for the gas market, at least. And I look forward to hearing more of that from you over the next few minutes. I mean, we're going to try and focus our discussion in the next 10 minutes or so on integrated oil and gas companies such as OMV. You are a typical one of those. You have upstream operations across Europe and the Middle East, across the world, downstream partnerships and refining in the Middle East, and as well as chemicals and even gas storage. You were just mentioning gas there. So we look forward to having your views on that. I would like to start by asking you, on the energy transition front, what is your company doing, and what are companies like OMV doing to be able to progress with their energy transition? A lot of these private companies are under pressure from their shareholders, you could say, to kind of move forward on that front. At the same time, you're having to deliver profits, hopefully every year, to those same shareholders. So how are you balancing those 2 objectives?
Well, first of all, I think we're also focusing on renewable energies as one major step, especially to reduce your CO2 emissions. We have been about a year ago, or maybe 2 years ago, we have been at a crossroad to decide which path we want to take, whether or not we would like to transform our oil and gas company into an energy company so that we should invest more heavily into renewable energies. But when I was looking into all the projects, I found out that the rate of return I could get from these investments are far away from the rate of returns I was used to in my upstream investments. And I also asked myself, do I really have a competitive advantage so that I have a long-term view also to be very successful in energy, in power markets? So we decided against, because we have said, okay, if I look into my DNA as a company, especially integrated into the value chain towards refining into petrochemicals and chemicals, we have decided that OMV is now following a strategy that we would like to transform the company into petrochemicals, into the value chain of chemicals. And especially what we have seen in 2020 is that this business was pretty robust. Especially we have seen stronger demand in packaging and in healthcare stabilizing the business. And we think that this has to be accompanied, especially when we talk about a sustainable transformation. It has to be accompanied by a heavy engagement into recycling. So OMV is preparing in the long term for a circular economy.
So just to ask you a bit on your sort of transition towards more petchems, as you're saying, that's become your focus rather than renewables. What's the timeline for that for OMV? Currently, you have a balance of oil and gas production. I believe gas is slightly more weighty than oil. But what's the timeline for converting that pipeline, if you like, or that value chain of oil into petchems? And where do you see that going?
Well, we have already started last year, and it was an anti-cyclical acquisition we did because we acquired the majority shareholding in Borealis, which is one of the leading companies in polyethylene and polypropylene, the biggest producer of ethylene and propylene in Europe, for example. And if you look now into our portfolio, OMV can demonstrate growth by 1/3 from one day to another with such an acquisition. So it brings growth, and it brings sustainable growth with the transition. And if you look now into our capital allocation, and you will see that already nearly half of our business is in chemicals with such a big step with the acquisition of Borealis. Of course, it's going to be the first step.
Yeah, and yeah. So are you looking in terms of expansion into Asia, expanding into partnerships there? The Asian refineries themselves are restructuring and seeing this point of actually diversifying into petchems to survive and to expand. So geographically speaking, you're already in the Middle East in partnerships in refining. Are you going further east?
No, I think we are fully in love with Abu Dhabi. We have very strong partners, especially we enjoy very much our partnership with ADNOC, and we are operating the world's largest cracker together with ADNOC in Ruwais via our joint venture Borouge. And we are more thinking about an expansion of our joint venture Borouge with further investments into Abu Dhabi, because you have to ask again yourself, if you would like to supply out of the Middle East into the Asian market, you need to have a competitive advantage. And I think sitting on a gas field and having just the ethene cracker sourced nearby, and you don't have these large logistical costs, is a competitive advantage. And we will build on our position we have together with ADNOC in the Middle East.
Okay, and what's your point of view of, I mean, this is obviously all going to require a lot of investment on your part, on other companies who are doing similar moves. In terms of the year 2020, clearly a big shocker to a lot of oil and gas companies and across other sectors as well. How has that impacted the thinking towards, forward energy investment continuing with the commitment to invest, whether it's in petchems or other. How much of a challenge was that for OMV last year in terms of your planning?
I think it was a challenge for the entire industry because we have had to deal with less cash flows. The operating cash flow was heavily impacted. So the room to maneuver the company, especially everybody was cutting back investments. But if you look where we have cut our investments, it was mainly in upstream. It was a little bit in refining. So that's why I think you will see with the time lag that the industry really heavily cut back. On average, it was about, in our case, by 1/3. We cut back our investments. But the financial markets, and we have been very active in the bond market last year, was not really infected by the COVID pandemic. So you really could source cheap money out of the financial markets. And with that fresh money, we financed, for example, the acquisition of Borealis. So we invested heavily into the transition. And what I can see is that especially the green policies, especially of the European Commission, is incentivizing that you spend further money and invest additional money into renewable energy so that there will be a push. But the question mark is, of course, whether or not you have also an economic case for such investments. The industry can't survive if we build only on subsidies in the long term. So that's why I think, yes, the transition will take place. It is incentivized by big budgets from the European Commission, but you have to ask yourself, what is your sustainable business case on a standalone basis?
Okay, and just one more question to you, Dr. Heine, before we move on. Just in terms of the view ahead for 2021, as you said, companies like yours are making big decisions on investments. What is your point of view on where we're going with real demand returning to the market? It's not a question for you to answer. Nobody can tell us where we are with that. But how optimistic are you? I mean, obviously, Europe's going through a hard time now, back into lockdowns. The vaccines are there. They're being rolled out. What's your point of view of when you would see a real demand, realistic demand recovery for Europe kicking back in, putting aside the cold weather that you just mentioned at the beginning of our talk? Some pessimism emerging at the beginning of January on how quick the effect of these vaccines is going to have, or how much of an effect it's going to have on actual real demand, at least until July or August of this year.
Yeah. Well, first of all, I'm an optimist. I think if you don't want to visit a psychologist in these days, you have to be an optimist. And I think it's more fun to run a company if you have the optimism in your thinking. So I think that our industry, or let's say more or less all the industries, are going to face a difficult first half 21. I'm not too optimistic for the first half, but what we can see is that our industry, well, we had a good start into the year, into the first half of 21. If you complain about the prices, and you have mentioned it, I think that's not the right thing to do. And I think the second half is more the big hope. I think that oil demand will not recover to the 29 record level of 100 million barrels per day in 2021, but mid-22, I think that's a good outlook from my point of view. We will see some of the recovery also in the second half with the refining industry. At the moment, I would say I have more concern in refining than in upstream. We have very weak margins.
Would you see that strength coming, that pull, obviously, on demand and refining coming really more from Asia, continuously relying on Asian demand really to pull all the...
I can't agree more. And it's all a story about jet, and if vaccination really will kick in and we will get more back to a normal life in second half this year, I think jet demand is also coming back. This is what I can smell from the airline industry. But we see already naphtha being priced under much better terms. So some products, refined products, already in the first half might give us a little bit of a backwind.
Thank you very much. So, as you said, jet fuel and the return of travel and mobility across regions is going to obviously pull the industry back into shape. Thank you very much, Dr. Rainer Selle, CEO, for joining us for this.
Great
please
pleasure.
continue to listen in to this session. I am going to ask you please to switch off your camera, but do stay with us. Thank you very much for joining us. And we will now move on to our next interview, the feature interview with Sir Mark Moody-Stewart. I'm delighted to, first of all, introduce Mr. Christophe Roule, the Senior Research Scholar for Center on Global Energy Policy at Columbia University and the former Group Chief Economist and Vice President of BP, to conduct this feature interview. And I'm going to now hand over to Christophe, if he has his camera on, yes, and hand over to you, Christophe, to make the introductions and to conduct the interview. Thank you very much.
Thank you. Thanks for the introduction. This leaves me to introduce our guest, Sir Mark Moody-Stewart. Sir Mark, please switch on the camera and the microphone.
Yeah, I've done it. I
can start it.
Good morning.
I looked it up for a raft of positions, present and past, including, of course, Chairman of Shell. A good morning to you.
Good morning.
Afternoon, good evening, what the case may be to the audience. It's always difficult these days to figure it out. Where are you joining us from?
I'm in southern England, in Sussex. It's not too cold.
Not too cold, but subject to the British.
Very wet.
Subject to the British lockdown. Let's start on the light side. If you had to make an estimate in current circumstances, how much would your personal oil and gas consumption have been reduced the last few days under the lockdown?
Well, my heating bill has gone up, but my transport bill has definitely declined to zero, almost zero.
Yeah, similar here from Germany, where I call. This is the European session. But we are asked to discuss the global oil markets, not our own circumstances. And global oil markets are in a peculiar situation, as you know. We have, of course, seen this massive hit to demand when the first round of lockdowns first came. We have seen the emergency meeting in April, brokered by the US administration, bringing OPEC Plus together again. And we have seen a 2-year plan for cuts in production. And I think it's fair to say that since then, we have seen an amazing and astonishing degree of discipline in sticking to that plan, and in some instances even exceeding it. Sir Mark, going forward and concentrating on the short term, when you look at this success, which resulted now in prices north of $55, will it not wake up the private producers who have not been part of those lockdowns, in particular the US shale producers? And do you think oil demand has improved in lockstep for enough to make space to allow production from both OPEC Plus and shale producers, private producers, at current prices over the course of the one?
Christophe, I think we're at a bit of a turning point, which I think has been coming for a number of years. Oil is a very unusual commodity. It, unlike most commodities, in most commodities, iron ore, copper, nickel, and so on, the major low-cost producers dominate the market, and the higher-cost producers pick up the tail end. And they tend to be quite well-managed markets. Now, in oil, we've had a managed market, but it's been managed by the low-cost producers, restraining their demand to keep the prices up. And that works very well if demand continues to grow. But sooner or later, if demand flattens or stops growing continuously and reliably, there has to be a change, I think, because you can't go on restraining production as OPEC has done for 45 years now. And I think the drastic drop in demand brought on by COVID has brought forward this potential change. So I think the low-cost producers are now in a challenging position. Do they want to continue with the restraining production in flat demand, which means losing market share. Previously, they were happy to lose market share as long as the price was high and the total market was growing. So although they lost share, their production could climb a little bit and the prices kept well in line with inflation. That's going to stop, I think, and it's a challenging moment for the low-cost producers.
I think that is an extremely important topic, and an extremely important topic which is underappreciated, in particular for the long-term consequences, and we'll come to that in a second. But let's approach it from today's point of view. I'll take it that you believe that demand has not kept pace with the combined power to produce oil from the private sector at these prices and from OPEC Plus when they loosen discipline.
Oh, absolutely not. And I think as prices go much above 50, as you put it, it will waken up demand. Certainly, shale demand in the shale production it will waken up shale production in the States. There is a little bit of a green light because, or an amber light, because of course the international oil companies have cut back radically on their investment in conventional oil. So there's no doubt that conventional oil has globally been underinvested in, and that does provide space for the low-cost producers to produce into the decline gap as conventional production declines. Not that it need to decline. At the right price, you can go on growing for another 100 years. But if the demand flattens, you get into this fix that I'm talking about.
So that gives rise to two questions for the short term, if we stick with 21, 22 for a second, before going to the big topics.
Yeah.
One would be, are we entering a world in which demand is so slow that prices will be kept low and so the recovery is going to be very sluggish within the next 2 years? Or are we entering a world in which investment has been so low, in particular private sector investment, that this famous investment gap, which always makes its rounds through the commentaries and literature when prices fall, that this time it actually materializes because the hit was so much stronger than anything we have seen before? Which one of the two you think is more likely?
I think there is a chance that in maybe not in the next 2 years, 3 years or so, that there will be a supply shortfall arising from that drastic cut in investment, which continues to this day. I mean, investment in conventional oil is low at the moment. So I think there is a possibility, and that could lead to a price spike, but it could also lead to the low-cost producers using their spare capacity to bump up their market share, which I think would be a wise thing to do.
Which, from what you said, will still be ample at that time when it happens. So
I think recovery will be slower than we think. It's difficult, and we heard from the session just now about possible recovery, transport, and so on. But the world is a very big place, and OECD oil demand has been declining for quite a while, and it's been offset by the growth in China and the developing economies. And while China may be okay, I think the rest of the world has suffered wickedly from COVID, and I'm not sure that their recovery will be very rapid. So I think that will have a dampening of short-term demand. So I'm not optimistic about demand coming back rapidly over the next 2-3 years.
You're already walking down the right path, because of course I have to ask you a question I think everybody else has been asked before, which is, with your outlook on demand, with the fact that actually demand in the European Union, believe it or not, in today's countries of the European Union, has peaked in '79, OECD demand in 2005, as you mentioned, compensated for by Asia. Do you see a demand peak over the next few years? Do you want to comment on that, or is it just too uncertain to comment on?
No, I do see a demand peak. I am of this. I've always been of the school of thought that my colleagues in the industry generally, they all accept that there will be a demand peak, but they put it sometimes decades ahead. And then you've gradually seen people coming back to saying, no, it'll be in the 30s. And then people saying, well, maybe in the 20s. And I am certainly in the 20s. That demand will peak in the 20s. In fact, I sometimes think it may have peaked already.
That was my next question. May have peaked in 2019?
Yes.
Yeah.
But
okay.
But let's face it, there's not a huge difference between demand is a difference between two very big numbers, and that's always difficult to predict. And whether demand grows at a few 100,000 barrels a day or drops a little bit, I don't think it's going to collapse. I think it will be flat for a very long time. But I don't think it makes much difference to the big picture whether it climbs, you know, 1 million or 2 for the next few years, or it declines, stays more or less flat. The macroeconomic thing is more or less the same, flat demand.
So let's go to then what does matter in this picture, which is if we agree that demand will peak soon, may have peaked already, and that it more likely to look like a plateau and a general soft decline, we can agree on all of that. You're very well known for having drawn out the consequences of that happening in terms of the configuration of the oil market. And now I would like to come what you said earlier. What are the implications for low-cost producers on one hand, for associations, organizations, cartels, whatever we call them, like OPEC, OPEC Plus on the other hand, and for private producers finally? How does the market change? Why do you think this plateau or this peak demand plays such an important role?
Well, when demand is flat, the low-cost producers cannot simply continue cutting their production in order to make space for high-cost producers. That happened, if you go back over the last 45 years, it hadn't. It's what saved the North Sea, brought on the North Sea, North Slope, Alaska, Gulf of Mexico, deep water, and more recently, shale. And that works fine if demand is growing, and the low-cost producers might lose market share, but their total volumes go up and they're well served by the price. And I think that's the fix that the low-cost producers are in. Now, they have very wisely, I think, invested in spare capacity so that at moments where the prices are high, they can fill the gap and grow their market share. Saudi Arabia has done that quite successfully recently, although now we see them cutting back by 1 million barrels a day. So today's situation, you can look at it in a couple of ways. Is it just the old picture continuing to play, or will there actually be a change? I personally think that there has to be a change, and that's very difficult to achieve because the low-cost producers in general, particularly Saudi Arabia, have major budgetary demands. So it's difficult to, the challenge of investing in additional capacity, which can easily be done in the Emirates or in Saudi Arabia, is that it costs money. And those low-cost producers have other demands on their cash, and therefore the production side is cash flow constrained.
So this, I think, is incredibly important point, which you have reiterated many times. So I want to dwell on it a little bit to make it very clear how these mechanics will work, which will change the market. I would agree with that. So we used to have, you're saying, and correct me if I'm wrong, a situation in which low-cost producers could cut production that would bring prices up and benefit their revenues. That's why they did it. They would lose market share because that gave a free ride to the North Sea, to the Alaska slope, maybe to Brazil, certainly to shale. But they didn't care about market share because in a growing market, over time, the volumes they had cut were clawed back by growing demand. And at some point, the system was in balance again, prices came down again, and then a next round of these OPEC cycles would start. And what you're saying is the moment the market stops growing, producers, in order to just sell the same volumes as before, will have to take away market share from somebody else. That's the definition of shrinking market. And that, if I understand you correctly, will bring prices down and result in price competition.
Not necessarily. The previous model, as you said, was that the low-cost producers were generally happy with the volume that they produced. Volume was important. They produced 7, 8, whatever figure they, 2, 3, 4 million barrels a day, whatever figure they picked on, they tended to be reasonably happy with it, in spite of the fact that perhaps their share of the market was shrinking. I don't think it's necessary that prices will come down. I think there is because of production decline in, let's put shale, call it 10 million barrels a day, on it, that's 10% of the market. Put that on one side for a moment, whether it's growing or not. What is probably not growing is investment in major conventional projects. The international oil companies are short of cash. They have cut back on that investment. They will invest, but not to the extent they have in the past. So I think conventional investment in conventional oil will flatten and will not necessarily grow unless oil prices go very high and people begin to believe in $60, $70, $80 oil, in which case we're back into the old game, which I hope will not happen.
But isn't there more flexibility, in particular on part of these private producers? So I agree with the thought experiment. Let's put shale to one side. Let's put the political constraints of the energy transition, which may cause the shales, BPs, or even Exxons of this world to limit oil production. Let's also put that to one side. Just concentrate on the oil market question. Isn't it the case that in oil markets, costs always follow prices with a lag, but that these companies have been declared dead so many times and have always managed to bring costs in line with a low price environment, so that actually their returns to capital, if I remember this correctly, were very similar at oil prices of $20 than they were at $120 over the longer term. And wouldn't that indicate that this investment gap, again, as happened before, will not materialize?
Well, that's certainly very true. I think the market and the world has tended to ignore the inevitable impact of technology. The inevitable impact of technology, of course, doesn't only apply to the oil industry, it applies to alternative energies as well. We've seen that even more dramatically. So the renewable energy guys forget that same technology is applicable to oil and gas, but the oil and gas guys sometimes don't appreciate the speed at which it's happened in alternative energies. So I think it will be there, but it's a question of willingness and where companies are going to be putting their money. And if you are faced as knowing that as an international investor, knowing that there is a bunch of really low cost investment not available to you, you're always going to have a little few butterflies in your stomach as to what these guys are going to do. I mean, in a sense, it's irrational from a global point of view, the present system of low-cost producers constraining supply. You know, the world would be better if the low-cost producers actually did dominate the market. There would be a geopolitical consequence, of course, but that's another matter.
Are you aware of any other market functioning like the current oil market? You worked in the mining industry, you worked in gold, you have vast...
The mining industry certainly doesn't work like it. The mining industry I think, has a lot of lessons to teach the oil and gas industry, and vice versa. The mining industry never got around to production sharing contracts, which has got them into a lot of trouble. So no, I'm not. The mining industry, the difference is, I mean, shale is a bit more like mining, that the operating costs and the ongoing costs are higher, whereas conventional oil has extremely low ongoing production costs. Once it's on stream, it's on stream.
Yeah, so it will be difficult to find something. But let's continue the thought experiment, widen the time horizon even further. So we may not agree on the investment gap, but if it happens, it will probably be temporary. Let's think about a future in which the low-cost producers, as you say, are actually doing what they're supposed to be doing, and the rest is supplemented by more expensive producers. That raises two questions immediately. One, which you already pointed at, how do you think the current low-cost producers, in particular the GCC countries and probably also Russia, how well prepared are they for that cut in revenues, which lower prices would mean? And secondly, also of interest, I think, what would be the consequences in your view on the energy transition when renewables all of a sudden have to compete with a large segment of fossil fuels, oil, and to some extent perhaps gas, which has become much cheaper, much more predictable than before?
No, I think question one, I don't think that the low-cost producers are, well, whether they're prepared or not, I don't think they have necessarily a long-term strategy to get to the position they need to be in. It's going to take some pain, and they are short of cash. Personally, if I rule the world, and you may be glad I don't,
hope not. I hope I don't have to be glad you don't.
Personally, I think the answer would be for the low-cost producers to look at alternative methods of financing the additional production, so they could preserve their cash for other things, and then do what the Emirates and Saudi Arabia have begun to do with pipelines, saying we don't have to put money in, we can actually monetize some of this. You could begin to do that with production, not by inviting the majors in. I think that's most unlikely, and saying, bring us your technology. They have the technology. That technology, I mean, Saudi Aramco is one of the most sophisticated and advanced technical companies in the world. It doesn't need that technology from the outside, but it needs finance. And I think one could look at ways, I'm not a banker, but I'm sure there are ways that you could get at relatively low rates funding for those investments. That's the kind of that's the answer to the first question. And now I've forgotten what the second question was.
The impact on, or should we continue? I come back to the first one. The second question was of this more stable, more predictable, more low price environment, the impact on alternative fuels in the energy transition.
I think frankly, you know, you can, well, not forget about it, but the technology that you mentioned, I mean, I'm on the advisory board of Envision Energy, a very creative Chinese renewable energy company. And golly, you look at what's happening on battery storage, consideration of hydrogen, green hydrogen. I mean, what people don't realize, if you have wind energy, wind energy will always be so-called constrained. And that is free energy. You can put it into storage at no cost. So you can make hydrogen. The problem with making hydrogen is that the energy is expensive. But at intervals, from all forms of renewable energy, you have free energy, surplus energy, which can be stored. Can be stored in batteries, but batteries are messy things. They take a lot of mining and so on, good for the mining industry. But hydrogen, and I think the international oil industry and the national oil industry should really focus on hydrogen and hydrogen analogs like ammonia.
In a way, like associated gas, which you have here.
Yeah. Yes, exactly. You're right. Surplus renewable energy is like associated gas.
Don't say that too loudly.
It used to be free.
People may not like to hear that, but back to question one, isn't there?
Good idea. I hadn't thought of that.
Something good comes out even of interviews sometimes. Back to
Oh,
question
that's
one.
the chairman of Envision Energy. He'll love it. He normally refers to me as he used to refer to me as a representative of the dinosaurs, but actually he's changed his mind. He now calls me a representative of the elephants because he's very smart. He realizes that the international oil industry has this massive capacity, the cash flow from their existing, they have in trading, etc. They have skills which will, I believe, allow some of them to make the transition very well, but not all of them. Fortunately, they're going to be few casualties.
So here's another thought, connecting the first question, which was, about, which you answered with the problem of the producers to secure financing, and the second, which is the energy transition. Wouldn't it be, you said that it's unlikely that Saudi Arabia's and UAE's and perhaps Russia's of this world would invite in the big private majors, and they have the technology anyway, but wouldn't it be much closer to suppose that they would align with consuming countries, in particular with countries where consumption is also mediated at least through governments, big Asian countries?
Well,
it sort of completely change the picture. We would sit in Europe, say, and all the supplies would be no longer coming from IOCs or Western kind of companies, but from stale suppliers.
Yeah, it would be nice. Then you'd need somebody like me running the world to organize it. I think it's most unlikely to happen. It's the dream. If you will remember, for the many years when Ali Naimi was oil minister of Saudi Arabia,
the central banker of oil.
Ali always used to talk about the consumer-producer dialogue and how we needed to get together and come up with a rational oil price, something that was acceptable to everyone. And, well, it didn't really happen. It came close to happening. The next step would have been to go to rational production, but I just can't see it happening. It's a nice idea, but I just don't.
Luckily, that part is not even run by you, but by demand and supply.
Yeah.
I have one final question, which I think is which troubles me. Yeah, it's the last one, and I have difficulties understanding it. This is what you said about low-cost producers, about with the investment bump, COVID bump or not, the environment we are moving to when oil demand plateaus or peaks seems to be so easy to understand and clear that even I share it and understand it. Why is it that the whole industry seems to be not willing to look at this? You said they don't want to talk about peak oil demand, but it's much worse. They don't want to talk about the very serious consequences of peak oil demand. Why is that? Why is there this head in the sand thing?
Well, I don't know that there's really a head in the sand. I think the international companies are scrambling to see how, as was mentioned in the previous session, how you can make money out of renewable energy, where the returns are lower, but they come in a consistent pattern, more like LNG. So I think they're putting a lot of effort into that. So I don't think it's that they're not looking at it, but they're looking at a different part of the picture. Maybe they are looking at it and of saying what I say, look, can we really compete with these low-cost producers? The bit we haven't talked about, and we don't have time to talk about, is the geopolitical bit, because we would need a bit of a rational world with people respecting other areas of the world and accepting that there was an interdependency. And unfortunately, we've been moving away from that.
Yeah, hopefully not forever. You want to give it 1 minute? We get into trouble with
I think we're in trouble already.
I certainly don't think we have time to get into geopolitics on this session.
All right, that's one for next time then. Thank you very much. It was hugely appreciated, and as always,
Thank you very much.
They say Diala, they say back to you, no?
Thank you very much, Christoph, for that. And thank you to Sir Mark Moody-Stewart, as always, for joining us. Thank you very much for that, gentlemen. Please do stay tuned in, but I would ask you to turn your cameras off. And I'd like to take the opportunity to also welcome our audience beyond the Zoom world on other platforms such as LinkedIn, YouTube, Twitter, and the Bloomberg Terminal website as well, who are joining us throughout the sessions today. So welcome to you all as well. We're now going to move on to our Aramco Trading New Silk Road CEO of the Year awards session. These awards are given in recognition of individuals who have achieved outstanding feats in connecting energy systems across the New Silk Road route from Africa, Middle East, and through to Asia. They're now in their 4th year, these accolades. We've had the pleasure of giving 3 of those awards already today. And it's my pleasure now to introduce a former award winner himself, Mr. Thomas Wemel, the President of Trading and Shipping at Total Oil Trading, to introduce the next category and award winner. So welcome, Thomas, and over to you.
Good morning, Diala, and good morning from Geneva.
Good morning.
So it's my pleasure to introduce today the winner of the 2020 Aramco Trading New Silk Road CEO of the Year in the category of trading, Russell Hardy, the Group CEO of Vitol. From a Frenchman's perspective, and even more so from an engineer Frenchman, it is nice to see a British engineer. Russell has got a master's degree from Imperial College, heading up a global European trading company. Because normally the Brits like to pick CEO with an art degree, say in classics, history, or anthropology from Oxford. Russell has over 30 years of experience in the oil industry. After starting his career with BP, which sounded like the normal thing to do as a chemical engineer in the UK, Russell quickly moved to Vitol in '93, realizing that he had a brighter financial future in trading business than as a refinery manager. He has held numerous positions in product trading in London and in Singapore, and has joined Vitol's executive committee in 2007. He became CEO of Vitol in 2018. His first year as a refiner at BP gave him a very good understanding of oil products chemistry, much better than the usual trader would have. So I've been told that Russell is better at explaining technically challenging matters than most others in Vitol, and is therefore not just the CEO of Vitol, but also Vitol's CTO. Russell is an expert on everything, from futures exchange delivery rules to how to configure a refinery to deal with an off-spec cargo. I hope Russell will not feel offended if I compare him with a Swiss pocket knife. Obviously not the entry-level one, but the real fat, expensive version that can do almost anything, the all-in-one package Swiss knife. It probably explains why many Vitol employees refer to Russell as having 2 brains. But despite all of his talents, Russell appears as a very humble and low-profile person, which in our trading industry is not very common, especially when you have his track record. I am told that Russell likes to engage with staff at all levels in the same way as he did in a more junior position decades ago. And in that sense, he has admirably filled the late Ian Taylor's boots. All that remains for me to say is that Russell is a very deserving recipient of this year's award in the trading category. Congratulations, Russell.
So, well, thank you very much, Thomas. That was a fantastic little speech. You've obviously got a few spies in Vitol that helped you out there. Probably 20% is true. I do like technical matters, but I'm sure most of what you said is very is very overblown. So thanks Thomas, and thanks to the panel. We have a little glass memento of the day, and it's very pleasing to get this accolade. Can I wish everybody on the streaming, a happy 2021? It's obviously been a tough year for many people across 2020, and let's look forward to a brighter 2021. And thank you also to the organisers, to His Excellency the Minister of Energy and Infrastructure, and also to His Highness Sheikh Hamad, who supported the events. And obviously, it's a shame that we're doing it by TV and by webcam. It would have been much more fun to all be in the UAE together. So, 2020 was a tough year for upstream and for refining, and probably trading was one of those areas around the world that had an interesting year. And obviously we had a lot of volatility in the first quarter and the second quarter, and the second half of the year. We've been working our way out of this huge stock overhang. So I think across the trading business, many companies have done well this year, handling those excess oil volumes from the first half of the year. And I'd like to say, a big thank you to the whole, to the industry and to the rest of my colleagues at Vitol, because everybody's worked hard, and we've accomplished a good year by working together and dealing with all the difficulties of 2020. So thanks very much to my Vitol colleagues.
Russell, if I could interrupt there and congratulate you first of all, and thanks Thomas for the presentation and introduction. Thank you very much. And actually we're going to hear more from you, Russell, now, and more of your thoughts of how 2020 was for Vitol and going forward. So I'd like you to stay on camera and invite you to join Guy Johnson, anchor at Bloomberg TV, who's going to moderate a session with you now for us. So over to you, Guy. Thank you very much.
Diala, thank you very much indeed. And thanks for that introduction. I feel slightly underqualified holding this session. I only have one brain to Russell's two, which obviously is a huge impediment. Let me just get this video started. There we go. That seems to be working beautifully now. Russell, thanks for your time. You've already indicated that 2020 was a challenging year for many in the industry. Volatility, obviously, to a certain extent, is though a trader's friend. We've had trading scandals in Singapore, which we obviously need to focus on as well. Negative crude prices. Who'd have thought that would be something that we would be talking about as well? The banking sector, the finance sector, increasingly nervous about all of this. Large traders such as yourself probably done better out of this than the small traders, and you wonder whether or not that trend is going to continue. Looking into 2021, I'm really curious to get your perspective on what comes next. We've got the vaccine rollout, that's uneven, that's battling rising case counts, increasing lockdowns. Certainly we're seeing more of that here in Europe at the moment. So let's get a sense of kind of where you see things going. We're only a few days into 2021. How is your outlook evolving?
Yeah, well, I think you covered a huge number of points there in 2020, and certainly, yeah, there were some difficult moments in the first half of the year with some banking difficulties for some of the traders out there that cascaded into a number of financial problems, particularly amongst the traders in Singapore. Looking forward to 2020, yeah, we have a positive outlook. we do feel that demand's going to make a significant recovery. That will be supportive for prices. Obviously, the market as usual is racing ahead and factoring in that positive news of the vaccine and the expectation of a better summer and a better second half of 2021. Obviously there are still large inventories around. The market's still very well supplied. But people are beginning to probably correctly factor in more optimism for the summer period and the vaccine rollout. Whilst obviously for us sat in London, we know very well it's still a very difficult situation. The economy is still very much locked down here, and people are not moving around freely. And we've all got to bide our time before we get too optimistic, because it feels like we've got 2 or 3 months across Europe and possibly across the States where the spread of the disease fights against the vaccination program, and hopefully the two will meet somewhere around Easter and give us a little bit better 2Q.
Does the unevenness of the vaccine rollout provide opportunities? Do you think certain economies are going to come back faster because they are ahead with their vaccine programs? And again, geographically, does that provide an opportunity? Within the trading industry, yes. It's probably slightly more advantageous to be in the East or in the Middle East, because the countries where traders tend to be based tend to be a little bit smaller. And obviously, if you've got a population of 1 million, 2 million, 3 million, it's a lot easier to organise a rollout of a vaccine compared to a population of 68 million in the UK or 300 plus in the US. So obviously those smaller countries can probably get through the population that much quicker. Just in the UK, as we know, it's a massive logistical challenge to get around everybody, and we've made a good start, but there's an awful long way to go. Do you see cargoes, though? One of the features of 2020 was volatility. We saw Asia coming back more quickly. That provided opportunities to shift cargoes there. I'm wondering if you see the same thing happening. For instance, if the US is ahead of Europe in terms of its vaccine program, its economy, will it come back faster? And therefore, does it take more demand versus Europe?
Well, I think you've got to get into the nitty-gritty of what demand has been lost, and obviously a significant part of demand that's been lost is within aviation. So the recovery of aviation, I think we all believe that's going to be an important part of the way the oil market plays out in 2021. Our research guys look at this all the time, and just as an anecdote, I think there are about 300 transatlantic flights a day at the moment, whereas typically there would be 1,200 transatlantic flights a day. Now, obviously, it's obvious why that's the case, but some of that restoration of people movement and business travel will be advantageous for the market to get itself back into a rebalanced situation. So, we've got a little way to go yet, but I don't think it puts any particular company or region at an advantage, because the oil market's very global, and of course the East is doing well, and the East is still going to attract molecules and barrels, because the East is still very much a deficit region for energy.
What did you read into Saudi Arabia's decision to cut unilaterally? Really, between the lines, what do you think was what you took away in terms of what they were saying?
Well, I think it's been a tough year for many of the OPEC plus nations. There's been a lot for all of the member states to deal with, and I think if we can call it a gesture or a decision by the Saudis to offer this additional million cut for 2 months, then I think it's probably had the required effect. It's given the market a little bit of a spur, and it's at a time when clearly Europe is struggling for demand. We do see things very much sideways for the next 2 or 3 months here in Europe, and that pickup in demand crude oil and for refining is only going to come April, May, June timing. So the cuts, they physically fit what the market needed at the moment. So I think that's why the markets looked at it so favourably.
You talked at the beginning about kind of when demand comes back, but you also talked about the fact that the market will front run that. The market is a discounting mechanism. It looks forward. It's looking at the back half of this year rather than the front half. Brent's already up 45% though since October. Is that a reasonable move in terms of what you see in terms of pricing? As we just discussed, the Saudis are going to keep things pretty tight. Inventories, you've already discussed this as well, are coming down pretty fast. You could argue some of the majors are underinvesting at the moment. Asia's come back. Is where we are now in terms of pricing reasonable, or do you think we're over our skis?
We're probably a little bit ahead of the skis at the moment, but that discounting mechanism, it's such a, there are some massive numbers to get your head around this year. We're expecting demand to increase by 6 to 6.5 million barrels a day this year. It's an enormous change. So dealing with that makes coming to these conclusions on sort of pinpoint accuracy very, very difficult. So where's that demand going to get covered from? Well, it's going to get covered from additional OPEC plus production. And as you just pointed out, those increases are coming, but they're coming probably a tad more slowly than we might have anticipated a couple of months ago because of the virus effect here in Europe. But we will need that production later on in the year, and the market is fast forwarding to a point where it's where demand kind of catches up with where it was in 2019. And with that catch up, we're going to need more OPEC oil, and we may well need some more shale oil as well. So the market is anticipating that, and it's ultimately trying to get ahead of that potential supply problem later on in the year.
Contango last year, backwardation this year.
Yep, we're there already. I mean,
yep.
It's, I think the whole curve is 50 plus, right, all the way down the board for Brent, and yeah, it's not a reflection of today. It's a reflection of where the market will be getting to later on this year.
Just as an aside, we're getting the effects of the polar vortex at the moment. You've already seen it out in Asia. It's pretty chilly where we are now in Europe. It's likely to get cold over the next few days, even colder, we understand. Gas prices in Asia are at records. LNG prices, it was a huge move in UK nat gas yesterday. What do you make of this? Are you able to take advantage of it? What are your gas guys saying?
Well, there's a huge move in UK nat gas today, but it was reversing yesterday's move. Yeah. So it's a market that's got slightly driven by fear. Obviously, Asia was short LNG. There were various production problems. This has been going largely for the whole winter. It's not a sort of January the 1st phenomenon. This is a phenomenon that's been in existence for a couple of months. The supply problems have left inventories a little bit shy of where they need to be in Asia. And when companies reached out to buy additional supplies, spurred on by low temperatures, those additional supplies weren't there. It drove prices higher, and we've reached a point really where we've got largely an illiquid market in the prompt because there's not many buyers around and there's not many sellers around. So trying to pin exactly where fair value is a tricky situation at the moment. But there is and there has been genuine need for product amongst Asian utilities. LNG from Europe and from the US has made its way to Asia to the extent that it possibly can. Those voyages are longer voyages. There's limited amounts of shipping in the LNG market. And so as a result, Europe is a little bit starved of its LNG cargoes. LNG is not the biggest part of the gas mix in Europe. But it is a growing and important part of the gas mix in Europe, and having those cargoes, let's say, taken away and sent to Asia, which is what the price and the markets are telling people to do, has left Europe tight. And then with the threat of a longer, colder winter than people would probably typically expect, then yes, we're repricing in Europe to reduce demand for gas, and that repricing will encourage the use of other fuels within the power sector. And it's probably encouraging more coal use, which in turn is encouraging the carbon price up. I mean, it's a typical cyclical effect.
Let's move on and talk about what is happening within the trading business. We've discussed.
Hi, can I just encourage you to perhaps ask the other panelists to join for the next session, just to keep an eye on time, so we give everybody the chance to join in, if that's all right with you. So go ahead.
We started a little late, which has left me a little behind in terms of my questioning. Okay, let's bring in everybody else, because I suspect they're going to have a view on all of this as well. Martin Frankel, the president and CEO of S&P Global Platts, joining us now. We've already heard from Thomas Waymail, the president of trading and shipping over at Total Trading, and Christian Morsch, the CEO of Odfell. Gentlemen, welcome all. Unmute yourselves. Let's keep the conversation going. Russell, I'm actually just going to continue with you for just a second, then we'll get the other guys in. The trading business this year has been obviously affected by negative prices. We've had the trading scandal in Asia, the Hin Leong scandal. Banks are kind of backing out. Is ultimately this going to be good for the biggest oil traders, the biggest energy traders, such as you? Are we really going to see this working to your advantage?
The events, the Hin Leong events, are obviously they're obviously a very serious matter, and they affected the banks badly. And it wasn't the only problem that the banks faced. So obviously that is important. It is important that banks look to their client base and ensure that they're lending to people they're comfortable with. Now, is there a flight to quality? Yes, there's probably a little bit of a flight to quality. I don't think the market's really felt it yet. Obviously there's some changes in flows. Some business that a company like ours can pick up simply because there's a few less competitors in the market chasing that business. But I think that flight to quality is going to be more likely to be spotted and evident when we have higher prices, because at the moment most companies are operating with lower working capital requirements because prices are relatively low. So your need for debt will increase as prices go up, and that's the point at which we may hit some ceilings for some of the firms in terms of what they can do because of a lack of liquidity. Now, I don't think that affects us. We have a very strong balance sheet and we have very good strong banking relationships, but for some of the smaller players, yes, they may face issues as prices move higher.
Okay, let's bring the other guys in. I also just want to bring in the survey question as well. That probably is a good starting point here. And the question is, and I'd be really interested to get everybody's take, not only the panel, but everybody watching as well. Remember, you can ask questions via the chat feature. Have we entered a decade of peak oil demand, or potentially could that be behind us? So let's get everybody's take on this. Thomas, your thoughts on peak oil? Thomas, I'm not sure we can hear you. Thomas, can you hear us now?
Yeah, I can hear you. Can you hear me? Yeah.
Yeah, so, perfectly. Thank you.
Good morning again. Peak oil is a beautiful subject for the strategist of Total. Being an humble trader, I'm just looking at next year. Having gone through 2020, I'm trying to get ready for 2021, and I see the demand recovering for 2021 because of vaccine, because of cold wave, because of a lot of things. So I will have to pass on this question regarding the peak oil demand, if you allow me to.
Well, let me ask you in a different way then. Do you think we ever get back to the levels of demand we saw in 2019?
I believe that, and maybe we're a bit optimistic here on the trading side than some of our peers, but we believe that by the summer 2019 and latest by the end of 2019, we will be back for most of the products except for jet fuel. So, you know, we see it by the summer, some people see it a bit later, but jet fuel is obviously a different animal. But for the rest, I think we should be back. We hopefully gonna get back, and the vaccine, you know, obviously deployment of the vaccine is gonna be the main driver of that. But we believe we should be back. To the demand of 2019 by the summer.
Okay, Martin, let's get your take on this.
We don't yet think that we're near to peak oil demand. To be straightforward about it, we still think that that's in the 2030s and possibly in the second half of the 2030s. Obviously, there's still a lot of moving parts, but I think one needs to get back to basics and sort of try and move out of when one starts thinking about the long-term peak oil demand and start looking away from the near-term COVID factors and think about what drives oil demand over the long term. And things like the growth of the global middle class are really big drivers for oil demand, which drives transportation and indeed petrochemical use. And then you have to think about if that trend is still intact, which it is, with a major hiccup. And I think it's been mentioned in some of the earlier panels as well, that some countries obviously have been very, very badly affected probably for years by the pandemic, but that trend is still intact. So if it's not going to convert into oil demand, then we need radical technological and societal change, either in the infrastructure or in the behavior patterns. And both of those things are starting to play out, but they're not going yet fast enough. So we track that in our analytics business very carefully. So until we see either the technology or the behavior really changing dramatically for the long term, that oil demand is going to continue to grow, we feel, once it starts to come back.
Well, Christian, let's pick up on that. You are mainly focused on the products markets. You ship that around, and 2020 in some ways was, as you pointed out to me a little bit earlier on, quite a good year. People have not traveled. We've talked about the return of travel, but what that means is they're consuming a lot more products. And as a result of which the petrochemical industry has benefited from that. Christian, do you think that continues? Have we seen COVID-19 marking a turning point in terms of that demand? How do people come back into the market when they can travel? Like, how does demand change? Do they come back straight away? Do they start traveling straight away? Do they therefore consume less on the petrochemical side? What is your take, Christian?
That was a very broad question, Guy, but I'll try to break it down. I think, first of all, I think COVID-19 makes it very difficult to see clearly what's what at the moment. And I think just very briefly on the peak oil, I would personally be very surprised if we were there already. I think, but whether it's 5 years or 10 years out or 15 years out, even it doesn't really matter from a strategic perspective, because we have to worry about the trend. I cannot speak about the short term like Total and Vitol can, but I think that's the way things are heading, with a diminishing demand at some point. I think we transport and we store chemicals that comes mainly out of the organic chain, which derives from oil. And what has surprised us actually a little bit in 2020 is how resilient that demand picture is. We transport more than 600 different commodities, and they go into things like fibers and food wrapping and car seats and even into the vaccine. I learned only a few days ago we actually store some of the products that goes into the vaccine production. So all of these things has surprised us actually in how resilient demand has been. And I think one of the points is that what the general consumer is saving on traveling and holidays and service industry in general, a lot of that has been put into kind of demand for consumer products, and that's helping kind of the chemical industry. So we're seeing quite resilient demand picture for us. I think the other part of your question in terms of traveling, what's going to happen, I have a hard time seeing that in the next month or two we're going to start traveling, those who have a vaccine passport, because as you also asked one of the other participants earlier, the vaccine is going to be rolled out in different countries and at different times. So I think we're going to be well into 2021 before we will see any kind of normalization of travel, probably into 2022. But of course, the big question is what's going to happen to other transport sectors. But I think 2021 we're still going to have quite a long way to go. Although I heard Russell say that demand is going to grow by, call it 5-6 million barrels per day in 2021. That goes very hand in hand with the economic growth that we are expecting. Yep. But how much of that will actually go into transport, which is the biggest part of oil demand, is a question mark.
I'd like to welcome at this point our audience on Bloomberg Television and Radio. I know Fran and Tom are listening in, so we certainly welcome everybody joining us in this conversation. Russell, let me bring you back in then at this point, the CEO of Vitol. Russell, you talked earlier about how you expect jet fuel demand to pick back up. Is jet fuel demand now basically what the oil market is going to hinge around?
Yeah, I think so. If you look back to August, September of this year, last year, the summer period when the virus abated, demand bounced back pretty quickly for road transport. So you can kind of see that same behavior happening again this summer after the virus has passed. People get on with their lives and start to move around normally. And do some of the things that they haven't done for a year or two, which may well involve some additional demand because of, they haven't traveled, they haven't been on holiday, and they do have, in some cases, they do have savings due to a lack of spend over the last year. Now, in terms of aviation, I think it is a more complicated picture. Airlines are not. They've had a tough time. They've cut capacity. There seems to be a permanent cut to capacity that's been made, and therefore we probably need to be a little bit cautious about how quickly it's going to come back and to what extent it's going to come back, because it's probably more like a couple of year build back from here rather than a sort of an immediate bounce back, because schedules have changed. As we know, all the 747s of British Airways have gone. Capacity will be down, and as a result, people will certainly not be traveling as much as they were in 2019. So we still see it likely that we exit 2021 with still 1 to 2 million barrels of jet demand to recover. I.e., we will not leave this year in the same way we left 2019 in terms of aviation demand.
Thomas Wehmer, what do you make of this? Where do you see jet fuel going? What are you guys anticipating? How are you positioned?
No, as I said earlier, I think jet is going to be the latest one to recover, as Russell says. Now, one thing that has been very remarkable during the year is the refiners have been able to do without jet demand during the year. They've been addressing the jet production and reducing the jet production to almost zero, so that jet is not a fatal product of the refinery. You can live with a demand for jet that is lower than what you wanted. So it goes either into the diesel part or it goes into naphtha. You just reorganize a bit your refinery. So the world can live with a lower demand of jet for another couple of years or lower. It will impact the global supply and demand, but it's something that the refiners have been remarkable about doing the year 2020 already. So the world is ready to live with lower jet demand, I think.
That's interesting, and it becomes something that becomes more structural. Martin, Let me ask you a question about what that means for price going forward. And as we start to make the shift towards a greener economy, how that also affects demand as well. What do you, is 2021 the year that we start making the shift towards the green economy? We think, we've all discussed that peak oil is probably further away than some people are anticipating. I've heard a lot of people talk about it already being in the rearview mirror. That doesn't, according to you guys, seem to be the case. But in terms of the effects of COVID on the green energy shift, when do we start feeling the effects of that?
Well, I think we've been shifting towards the green energy economy for a number of years, right? If I just think about my own company, Platts, I mean, we started assessing prices of biofuels, for example, 15 years ago, and at the time that was, you know, that was a big deal, right, in terms of green economy. So I think we're on this gradual transition towards green economy, which is transitioning, but like all transitions, it takes a long time to play out. So the question is whether COVID's significantly accelerated that transition, and I think that the jury's out on that. And I mean, Thomas complimented Russell as being a distinguished UK engineer, and as someone who actually is a humanities graduate from Oxford, I find myself in vigorous agreement with pretty much everything that Russell has said about the supply and demand environment and the numbers. So the question is going to be, you know, has anything dramatically changed in terms of how we're going to meet that pickup in demand? And I think things like, you know, sustainable aviation fuel are in their really early stages, and they're probably going to be important over the medium term, on the longer term, but they're really early stages at the moment. So I think we've still got quite a way to go on that. And I think that the one area where maybe I differ a little bit from Russell is that I think I very much agree with him in the base case. I think we may be underestimating in sort of second half of 2021 and going into 2022, that, you know, that as some economies, particularly, you know, the big economies, that people do get vaccinated and things start to return to normal, that we sort of see a euphoria bounce, right? And that things go back to quote unquote normal more quickly than we anticipate, which is a little bit what we saw in the summer when people thought things were better, they wanted to go back to their old lifestyles. So I think if we do see that euphoria bounce, it's not going to, in the short term, get met from the green economy.
Russell, what do you make of that? Do you think that we are in danger of underestimating people's potential to want to get back to their old lives, their potential to want to get on an airplane and go on holiday, their potential to want to get back in the car and start driving? You can't even do that at the moment here in the UK, really. You're not allowed to go more than 7 miles, I'm told, according to the Prime Minister. Just in terms of, is there a danger that we're underestimating the return to normal?
Well, I think the points Martin makes are valid. I think the transport demand, the petrol and the diesel demand will get back to where it was very quickly. As I said before, the aviation and the movements of people, you know, it's not going to be only us that govern that, right? And whether we want to buy a ticket to fly somewhere. The vaccine passporting, you know, whether, you know, take you know, somewhere that doesn't have too much difficulty with the virus, like Australia, you know, what are they going to require to allow their citizens to travel, or for us to go and visit Australia? You know, there are a number of unknowns that might slow things down, because the world won't be fully vaccinated. You know, I think there's a report that there's an expectation of about 10 billion doses to be produced this year. I'm not sure whether that's, you know, if you divide that by 2, because everybody needs 2 shots, that gets you around That gets you around 60% of the world population. I mean, we're not all going to be vaccinated. The world's not going to be perfect by December. You know, some countries will still have conservative approaches to travel for fear of letting something in that they regret.
Christian, I read a piece in the Sydney papers this morning, pouring cold water on the AstraZeneca vaccine. So it's going to be interesting to see how different countries react in terms of their approach. Have you been vaccinated with the Astra vaccine? Have you been by the Pfizer one? J&J? I don't know. We'll wait and see whether or not that becomes a reality. But Christian, just to almost kind of come back to what we were saying about the green energy mix as well, and in terms of how demand is going to develop, do you see a shift in how the types of products that you will be moving over the next few years? What are you anticipating in terms of the change in mix that you're going to have on board your boats?
No, I think within the petrochemicals or the chemical demand, I don't think that's going to change a lot. So it's very, we transport, as I said, 600 different commodities that go into all kinds of plastic and fibers and all that. And I think that's driven to a large degree, driven more by population than it is by economic growth. But of course, we are also exposed to economic growth. I think the biggest change for us is going to be what we burn in the engines on the ships, because the shipping industry has been, we have technology on board that's old-fashioned. I almost want to say combustion engines burning heavy fuel. And there's a very clear set now of targets from the IMO to reduce that. So there's a big technology race going on in terms of how do we adapt our engines on board the ships to burn cleaner fuels and be more energy efficient and so on. So that's actually the biggest change for us. The biggest change for us is not what we carry. I think if you were a product tanker owner, you probably have some of that, whether it's less jet and more diesel or more methanol or whatever it is, building components for further industrial production. But for us, it's the fuel that's the biggest change.
Okay, I'm trying to get to what has changed as a result of the pandemic, and I'm trying to figure out kind of what is happening. 2020 produced a number of different factors that I think will go into how the industry develops from here. Negative oil prices, we probably should spend a moment talking about those. The other thing I want to talk about as well is the trading scandals that have hit the industry. And what I'm wondering is does the industry digitize as a result of what has happened in 2020? A lot of industries have. We're all doing this via Zoom. That has been one huge impact that we're all feeling. What are the other ones, and what is particular to this industry that is going to come out in terms of the way that the industry operates? Thomas, this has been an industry that has dealt with paper for a very long time. Is this the catalyst to digitize? And what impact is that going to have, not only in terms of the trading scandals that we've had to deal with as well, but just in terms of the way that the industry operates? Is there now going to be an accelerating move towards digitization? And what effect do you think that's going to have, Thomas?
Well, indeed, there is two worlds in our oil business: that the paper, the derivatives market, and this part is already very much digitalized and automatized. If you look at all the exchange we got with the exchanges, all of that is done, totally digitalized, in a totally digitalized way. Now, the physical business is much less digitalized for many different reasons. And I agree with you, we should accelerate the digitalization, but it means that it takes a lot of standardization. Why can we digitalize the paper business? Because it's very standard. The physical business is not standard, because we cope with a lot of different situations in every single in every single country, where we just do a tailor-made deals to handle a specific situation. So standardizing something that is tailor-made is obviously complicated. But I think that we've all learned that we can do a lot more digitalization, that we need to do it to avoid some of the problems that happen in around Singapore and with the financial scandals you mentioned. And I wish we can accelerate on that. I mean, there's been some blockchain platforms that have been growing. VACT is one of them, and Congo is another one, and there is probably some others. The process is slow, but it's moving, and it's moving in the right direction. So yes, to me, I think we're going in a direction where there's going to be a lot more digitalization on the physical business as well as on the paper, which we are already there.
Russell, would you agree with that? Are you accelerating your decision making? Are you investing more in digital? Is blockchain the way to go? And does this also have the added advantage of increasing transparency, not only in terms of who own cargoes and how they're being sold? The banks obviously have a vested interest there, but in also just kind of the regulatory and compliance side of things, just understanding that the industry needs greater transparency.
Yeah, for sure. We all, I think, acknowledge that ESG is going to play a bigger part in our future, and that operating the right way is demanded and expected of us. When it comes to digitalization, I think there are lots of aspects to it, and a bill of lading signed by the master is still a very valuable document, and has been the cause of a number of problems in Singapore as well on the back of these scandals. But shipping law goes back a couple of hundred years, and it's not easy to completely transform the way physical commodities are shipped through blockchain. It's quite a complicated process. So I think Thomas is right. Companies like VACT are concentrating in one or two areas where it's possible to demonstrate the business model, like a barge in Rotterdam where the business repeats itself, or BFOE where the business repeats itself. But when you come into situations where cargoes are loading all over the world in different jurisdictions, with insurance, without insurance, different rules on the backs of bills of lading, it's quite complicated to just turn it into a digitized process. Now, where we do use digitalization is information and information gathering for our business. Those comments earlier on regarding the number of transatlantic flights. These are information sources that are coming from digital downloads that we try and pull into our database, so that we can understand the market better, so that we can understand how things are recovering, when they're recovering, the rate at which they're recovering, to better inform our traders and our businesses as to how to organize themselves for the future. So I think there are a lot of digital aspects that are positive. Obviously, we would welcome more, but I don't think we can flick a switch and blockchain the entire oil industry, because some of the issues in Singapore were not. They were. I'll use the word alleged frauds. There were accounting scandals. There were all sorts of things that had nothing to do with bills of lading or aspects of that nature.
Just before I bring Martin back into the conversation, I just want to have a look at the survey, which is quite undecided. Have we entered the decade of peak oil demand? 50-50, I would argue, probably on that one, within the plus or minus. There's another survey poll that I'd like to put out there as well. Do we expect the average price of Brent crude? What do we expect for the average price of Brent crude to be? Close to 40, 50, 60, or even 70? Well, let's talk about negative prices, because that's something that we had to deal with in 2020. Martin, how big an impact do you think that will have long term? It clearly had an impact. It shook up the finance industry. I'll certainly talk about that for a moment, because I talked to a number of people at the time who from a collateral point of view, were really shaken up by that. Do you think that ever happens again? Do you think that was a one-off? And what are the long-term impact it's going to have?
Well, I think to that extent and that scale, it's very likely a one-off. We hadn't seen something of that dramatic nature before, and there's not particularly a reason to expect that it will happen as dramatically again. But I think the basic principle of negative prices in commodity markets is not unknown or unusual, so I don't think that we should exclude negative prices again. And I think it's the underlying cause, if you like, which is the structure of the contract and the physical delivery nature of the WTI contract, and maybe some markets participants' lack of awareness of the technical details of that delivery mechanism. Those things for sure will occur again, right? Because we have markets which have got multiple participants and they've got multiple objectives, and sometimes those objectives can't get met by the market mechanisms. So I think it was exceptional, but exceptional in part of something which is part of our markets.
And what impact do you think that's going to have on the availability of financing? I just want to get your kind of take on this. Do you think, and I'm sure we've got two other large oil traders that are joining us, so we've already kind of learned that they see this potentially working to their advantage in terms of a bigger focus on larger traders. But do you think what happened in 2020 is going to change the way that this industry operates in terms of the availability of financing, the availability of capital? How big a shift do you think 2020 will prove to be? There were trading scandals as well that need to get rolled into the mix. I'm just wondering how that translates, do you think, into price?
Yeah, I think the availability of financing, there is a shift underway. I'm not sure if it's because of the negative WTI prices. I see that more as pressure on banks in terms of the ESG agenda, which we were just talking about. And I think also, particularly in the US, the relatively poor returns of the shale industry, right? So the risk reward of financing the natural resource industry has changed for banks over the last 2 or 3 years, and I think that's probably structurally the case. So I think that will impact the availability of finance. I think the negative prices will have probably a different impact, and it's one that we at Platts have been involved in, which is that people obviously, after a major market disruption event like that, take another look at, well, what's the right benchmark, what's the right price to be using for the particular activity that they're engaged in. And there's certainly a lively debate going on in the US about what's the right price for exports of crude oil out of the United States. And I think that's a different topic which will continue to get discussed.
I'm going to wrap things up in just a moment, but I think, Christian, I'd like to ask you the last question. You ship a lot of products around the world. I spend a lot of my time talking to bond investors who are trying to figure out where inflation is going. There is a reflation trade that's on. It is being driven by the commodity markets to a certain extent. And it's interesting to see that prices are expected to remain around 50. I've seen a number of banks, including Goldman Sachs, I think Citi as well, over the last few days, raising their price target to nearly 65. So it's interesting that our panelists see it kind of staying around 50. Maybe that is going to end up being the average over the year. But inflation is something that the bond market in particular is really focusing on right now, and they're trying to understand exactly where it's going. Kristen, you ship a lot of stuff around the world. It's more value add stuff. There is the potential, therefore, for prices to rise. I'm curious, do you see inflation this year?
That's a very, very, very good question. I think, and in many ways, it's an impossible question to answer, because if you have told a panel of economists before the pandemic, you've described what has happened to the shutdown of the world, and you had asked them to predict what would happen to the economy, I would wager that very few of them had said that we would be doing so as well as we are. So the fact that we are now talking about inflation and an expectation of inflation, especially in the US, is quite extraordinary, actually. So I hope they're right. I think the world would be a better place with some inflation. Of course, that's a positive sign. I do, however, think, and I cannot shake the feeling that, people talk about getting back to normal once COVID is gone. But the normal we're going to get back to is a normal with a much, much higher debt levels, whether that's private debt or sovereign debt or corporate debt or whatever. So the risk picture has actually increased for an economic, correction. So there might be an initial euphoria, but I think we should not just declare victory and say that we're going to have a stable inflation growth and interest rates are coming up again and here we go forever. I mean, I think there are some risks that are important to remember. So I would be surprised if it was a significant inflation. That would be my personal take.
I'm sure the bond market is listening. It's going to be interesting to see where prices go. We're going to wrap it up there. Thank you all so much for your time this morning. Russell Hardy, the CEO of Vitol, Martin Frenkel, the President and CEO. I think I've got that wrong, actually. I think you're now Vice Chair of S&P Global Platts. I think my original document had the wrong title on it, so apologies for that. Martin, Thomas Wehmel, the President of Trading and Shipping at Total, and Christian Morsch, the CEO of Vodafone. Thank you, guys. Thank you very much indeed. I really enjoyed talking to you all this morning. Diala, let me hand things back to you.
Thank you very much, Guy. And thank you, gentlemen, for that. A lot of fascinating insight from you all. Thank you so much. And we have a few minutes to go before we wrap up this particular session. We are now on to our fifth Aramco Trading New Silk Road CEO Award to deliver. And I'd like to ask Martin Frenkel to introduce the next category and indeed the next winner. So I'm going to hand that over to you, Martin. Thank you very much.
Thanks very much, Diala, and it's my great pleasure to introduce the winner of the 2020 Aramco Trading New Silk Road CEO of the Year in the category of shipping, and that is Mr. Christian Morsch, who we've just been hearing from, Chief Executive of Optiel. So congratulations, Christian. Christian has 33 years of experience in the shipping industry, including 6 years based in Asia. He has a background from several major Danish maritime companies. And in 2015, he moved to Norway to head up the leading global chemical tanker and terminals operator, Optiel SE. The company is listed on the Oslo Stock Exchange and currently operates a fleet of 89 chemical tankers. He leads a team of 670 shore-based employees based in 13 international locations and around 1,700 seafarers who sail worldwide on Optiel's chemical tankers. Christian joined the company from Clipper Group, where he was partner and group CEO. And prior to that, he was with A.P. Møller-Mærsk, where he held various executive positions, latterly as CEO of Maersk Tankers. He has extensive board experience and was a member of the Optiel Board of Directors from 2014 until he assumed the role as CEO. Other board assignments include Maersk Broker, J. Lauritzen, Clipper Group, and Nordic Shipping. He holds an MBA from IMD Business School in Switzerland and an advanced management program degree from Harvard Business School. So all that remains for me is to say that Christian Morsch is a very deserving recipient of this year's award in the shipping. Congratulations. Congratulations, Christian, and the floor is yours.
Thank you very much, Martin. I don't know if you could see me blush while you were speaking, but no, thank you. That was a very kind introduction. And I want to, of course, thank Aramco Trading and the jury for giving us this award. I think it's something that of course makes me proud, but it's a humbling award as well. I also want to say that nothing that has happened in Odfjell in 2020 has been happening because of any single individual, and that includes myself. It really has been the true test of a team. And I think this award really belongs to the true heroes of our company, and that is the people who serve on board our ships and on our terminals. So the rest of us have had, I almost want to use the word luxury. I don't use luxury about home offices very often, but in this context, we have had the luxury of the comfort of our working in safety from our homes, and the people on board the ships and on the terminals who every day have been exposed and putting themselves in the front line to make sure that Odfjell continues to deliver to our customers in a safe and sustainable way. They are really the ones who deserve this award. But anyway, I am of course very thankful. I'm very humbled, and I'm very proud to receive it. So thank you very much. I was supposed to hold up the trophy. Hasn't arrived in the mail, so I'm going to hold up a water bottle instead, which has been probably produced.
I am assured it is about I'm assured your doorbell is about to ring, Christian, with that, and apologies for that courier problem. But congratulations, and thank you, Martin, for participating in the presentation. Thank you both, gentlemen. Thank you. And thank you to all our audience and listeners across all platforms today for joining us on this European plenary session. Of course, we're moving now on to the round tables for Europe, which is a separate link, and there's 3 there for you all to choose from. And I'd like to draw everyone's attention to the next plenary session, which is the US plenary, which starts at 6 p.m. Dubai, 1400 GMT, and that'll be starting off with an interview, a feature interview with His Excellency Barkindo, the Secretary General of OPEC. So we look forward to all of you joining us for that plenary as well. And then we'll have a very, I'm sure, very interesting session on what's the outlook for US foreign policy under the new Biden administration. We haven't even mentioned what's been happening in the Americas yet, but we'll certainly have plenty of time and an opportunity to discuss that at 6 p.m. Dubai, 1400 GMT. So thank you all, gentlemen, for joining us. Fascinating. Thank you to Bloomberg for moderating that discussion. And we look forward to you continuing to join us on the roundtables and the next plenary. And have a good day.
Thank you, you too.
Thank you very much.